Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Manisha Gupta, back with your daily dose of commodities, cryptos and currencies. On the show today, we will be joined by Mukesh, Sahdev, who's founder and CEO at Xanalysts, and Jonathan Barratt is CIO of ETO Markets. Gentlemen, hi, thank you so much for joining in. But before we get to our conversations, let me get you a roundup of one of our top stories today. Well, last Thursday, China dramatically expanded its rare earth export controls ahead of a face-to-face talk between the presidents Donald Trump and Xi Jinping. Later this month, the world's largest rare earths producer added 5 new elements to its list of restricted rare earth exports. Following the announcement, U.S. President Donald Trump took to the Truth Social to write to an extremely lengthy statement saying that some very strange things were happening in China. In the post, he added that China's move would clog the markets and make life virtually difficult for every country in the world. Towards the end of the long post, he added that his administration was calculating a massive tariff increase on Chinese products coming into America. And then on Friday, the U.S. president announced that there will be an additional 100% tariff on imports from China, and they would impose export controls on all critical U.S.-made software from November 1 onwards. And then comes Sunday, where China retaliated, calling U.S. President Donald Trump's latest tariffs on Chinese goods hypocritical and defended its curbs on exports of rare earth elements and equipment. And then there's a turn of events overnight. The U.S. president then took to Truth Social yet again to write, "Don't worry about China, it will all be fine. Highly respected President Xi has had a bad moment. He doesn't want depression for his country, and neither do I. The U.S. wants to help China, not hurt it." Trump's announcements of additional 100% tariff on China's spooked markets worldwide. Wall Street on Friday took a hit. In fact, it's worse since the month of April this year. The Dow Jones shed more than 870 points. S&P 500 was down more than 2.5%, and the Nasdaq lost 820 points. However, once Trump posted that all was well with China, well, the Wall Street futures saw a sharp rebound. Meanwhile, markets in Asia trade are lower as investors are assessing renewed trade tensions between the two economic powerhouses. Hang Seng trade cuts with the cutoff nearly 2%, while the U.S. and China rift also weighed on the markets back home. As you can see, the Asian countries also are looking at a weakness in sense of equity markets there. Take a look at the crude oil prices in the meanwhile, and prices have risen more than a percentage point from a 5-month low reached last Friday after the U.S. President Donald Trump struck a conciliatory tone towards China's 2 days after threatening about new tariffs. On the geopolitical front, then, the U.S. president also declared that the war in Gaza was over as he flew to West Asia, where he is set to address the Israeli Xanalysts and co-chair a summit on Egypt on the ceasefire deal between Israel and Hamas. Jonathan Barratt is CIO at ETO Markets and now joins us for the discussion. Jonathan, hi. So much happening over the last 3 or 4 sessions. Markets do not know what to watch and how to react. And we have seen that happen in prices also. I want to first of all start with the crude oil prices. We saw a sharp decline on Friday. We saw prices decline below $60 a barrel. It's trading a percentage point or more higher at this point in time. The way crude is reacted to perhaps more tariffs coming in and then maybe not, and then a ceasefire, or maybe not as we move ahead from here. There are going to be statements even from here on. How are you looking at crude oil prices performing?
Manisha, good morning. Well, lots of volatility. I think what investors really need to understand is when Trump says something, it's more of the taco traders. Everyone talks about it, where he eventually just sorts of backs down. And that's another thing which we've exactly seen. Crude oil prices came under a lot of pressure. Trump reverses what he's saying, tries to placate the matter, and crude oil prices start to move back higher. I think the important thing is that there is a process in the Middle East occurring, and with that process, there's a little bit of risk off at the moment. And as a result of that, I think you will find that it's all about where we feel the economies will be going and whether we'll see that demand pick up. And I think if there are resolutions there, demand will pick up. And then I think oil in itself would have found a very low.
Jonathan, we are trading sub 60. Do you think the crude prices can stay there? Are there any price moves that you are forecasting now?
Look, I think at the moment, I think it's down at this level. I think it's an area where I think investors would look at. Obviously, India being an importing nation, I think it'd be a little bit concerned. I think when you see China, when you see Trump trying to placate China in terms of its economic growth, and we see that coming through, then we'll assume that economic growth will start to pick up. The key is economic growth. If there are reasons as to why we think it will be sustained, that will then support the price of crude. If we feel that not, then I think crude does come under pressure. Remember, we are coming into winter and peak demand in the Northern Hemisphere, so that should put a little bit of a low. So I don't see prices going dramatically lower. I actually see prices sort of starting to level off, form a base here, and I think they might actually start to move to the top end.
The second headline, and the most important one, Jonathan, continues to be silver in deficit. Yes, we've been talking about that, but the sudden squeeze and disparity across global markets, how do you see that?
Oh, look, I think when you look at silver at the moment, we've reached that level, that important level, US $50 an ounce, which came around in 2011. So I think it's a big squeeze at the moment. There's no doubt about it on the price of silver. And I think if anything there, that it falls in line with where we think gold is going as well. So when I look at the precious metal markets, I think the basis are there for them still to go up, but there's a lot of volatility, and those people there that are long will look to take profits. If anything here, I would like to see a pullback in order to establish some better longs.
And what is that range going to be? A support and then a target upside?
Look, I think if anything, I mean, like the upsides for both these metals are quite interesting. I mean, you look at gold, we can see it up around that, 4,200, 500. Remember, Bitcoin was around 25,000. It's 130,000. So you get a sense that these markets can continue to go. If I look at silver at the moment, 52.60 on the top side is a fudge number in terms of resistance, but very hard to nail it. But if anything there, 50 is now support, we know, because that was the previous high. So if the market breaks below that, breaks below 48.50, then I think she does go into a correction mode. But at the end of the day, silver is a good commodity which is needed across the board. So if there's a good growth story in the economy, it should bode well for silver.
Well, that's all new all-time highs that we are seeing on your screens. $4,070 an ounce for gold and 51.60-70 almost when it comes to silver. Jonathan, just coming back to silver yet again, and we do understand that London silver is trading slightly higher than where the New York silver is right now. There's a $2 to $3 of a premium that London is commanding. And when you talk about the Indian markets, well, Indian silver is trading at around 8 to 10% of a premium currently. I mean, depends, and that's quite fast moving as well. How would you look at this silver premium? We do understand that the deliveries are delayed. The liquidity is a problem right now. The borrowing rates are pretty high as well. When do you see getting settled in days to come?
Oh, look, I think it is that volatility, is that squeeze. It's the lending rates, which we've all got to take into consideration. And it always, when you combine that with not a lot of liquidity, then you can see prices really start to behave in a very erratic way. You might see a $5 to $6 range over the next couple of days, but it is really when that volatility comes, and then when we get liquidity in the market, will prices start to settle down. At the moment, very hard to tell, but I guess while you've got those rates out there at these levels, it'll only attract a lot more volatility.
Let's talk about gold then, and you've already given us a level of $4,200 to $4,500 an ounce. Where do you expect targets to be? But going forward from here, where do you see buying coming from? Central banks, yes, rate cut. Markets are anticipating one, though, of course, with that government shutdown in US, the data is difficult to come by. And then it also is about ETF buying. How are you looking at gold buying at these all-time highs?
Look, I think this to me is a very interesting question, because when you look at gold, at what level is the top? We don't really know. We do know that the moves have been based around a lot of uncertainty, US dollar debasing itself, and also central bank activity. It makes sense for the likes of China, India, all coming in there to try and buy that gold, because that's what they're all doing at the moment, trying to shore up their balance sheets and trying to diversify themselves away from that risk in that US dollar. That all does make a lot of sense. That also provides the basis for gold to continue to trade higher. But the question is, how does it trade higher? And does it actually consolidate? Because at these levels, the market is quite long. So as we know, markets don't move in one direction all the time. They've got to correct. But I do get a sense that if we do get that correction, people will look to buy. Remember what I did say about Bitcoin? No one ever thought it could get to these levels, 130,000. Look where it is. That could be a similar scenario where we don't know the high for gold yet. But if the basis are there for it to continue to trade higher, which I think it is, we can realise the targets we've suggested.
All right. Since you've spoken about Bitcoin a couple of times, Jonathan, I want to understand about that as well, because with the kind of sell-off that we saw across markets, and we did see 126 as an all-time high, we also saw 103 over the weekend as well. With that kind of volatility, and this is about alternate asset classes, this is not equities, it's about gold and silver and copper. We saw copper decline by 6% Friday, it's up 4.5%, 5% right now. How do you read the kind of volatility that we've seen across board?
Very difficult at the moment, very difficult from a trader's perspective, because you have to lower the size of your positions. Very hard to put a stop loss in the market. I would think that a lot of hedge funds are finding it very difficult to trade because of that. It is all about this uncertainty. It is all about we don't know what's next. And that to me is driving that fear factor into the market that's creating the volatility. You know, when President Trump says something, the market reacts. But people have to understand, but that's the way the government is, and we've got to be used to it, for another 3 odd years. So I think that volatility is here to stay unless something manic actually does occur. And then that's the case, then we'll get some direction. But I think it's very hard on the volatility, very hard to trade these markets. And the only thing I can suggest is reducing the size of the trades that you take on. And then just being very vigilant, because these things can turn around very, very quickly.
Oh, well, absolutely. Jonathan, just coming back to cryptos yet again, and the kind of liquidation that we saw over the weekend at around $18 billion is perhaps the largest forever in history since crypto has been around. Where do you see that money going?
Look, I think that's a very, very tough question. Because there's certainly been a lot of wealth that has been created on the back of this. And also a lot of the problems and issues about the regulation side of it as well, with so much wealth in here. I don't have a good handle on where I think it'll go, but all I know is that it's certainly going to be tested over the coming trading sessions.
Absolutely. Jonathan, one quick word on copper. Where do you see those prices going?
Copper, I think, is really interesting. We know we've got a supply issue out there. We know that's going to be here for a long time. Very interested in the fact the market did turn about face on the back of what Trump said, because that's going to hurt, or the tariffs were going to hurt global growth. Global growth, obviously, copper gets hurt. And I think that's what we've seen. But I think the market's also reacted. And I think that copper on a dip remains a good buy because of the supply problems that we have in the market. And I think that's going to be here for at least another 12 months or so until we can get it. Remember, copper is used for so many more things, also on the green trade as well. So there's lots of things as to why you need copper. And I think that deficit is there will help underpin any major pullback. So in my mind, still a buy and dip.
All right, so continue buying gold and silver and copper as well. And while, of course, the liquidity and volatility are a couple of things that we'll, of course, have to live with. Jonathan, as always, thank you so much for joining and making sense of perhaps on what really can be anticipated in days to come. With that, we'll slip into a short break, but stay tuned as we connect with Mukesh, Sahdev, founder and CEO at Xanalysts, on the other side. Welcome back. You're tuned on to Big C on CNBC-TV18 Prime. Mukesh Sahdev is founder and CEO at Xanalysts. He joins us to discuss in crypto in more detail. Mukesh, hi, thank you so much for your time. First of all, on what's happened over the weekend, really, on how are you reading it?
Well, Manisha, good to be on the show. I was listening to the previous person on what happened to the crypto. I talk more about the oil side of the market. And I think Jonathan made a comment, where will the money go? And I think the question could be, the money could go into the oil side of the equation. And you rightly pointed out earlier in the program that there's a lot of headlines, and I would say there is a lot of hard lines in the oil market space. So I can talk a little bit more about the oil market if you want to go there. But yes, I saw the view that there is a lot of money which is coming out and looking for some alternatives.
How are you looking at the crude oil prices from where they are right now, Mukesh? Because we've seen very, very big moves herein as well. And as Jonathan made a point about on how we could be looking at winter demand starting very, very soon. Is that something that you're watching out as well? Or do you think the kind of supplies coming in from OPEC and non-OPEC countries would continue to put pressure?
Excellent question, Manisha. But I would point some numbers here first and some data points. First, October is not a month of great demand for refineries for crude oil. It's a month where refineries in global systems take a pit stop. So the demand falls, at least in this period, in this part of the world. Then, yes, November, December, refineries do want to run their tanks and they may run higher, some crude demand numbers. So there might be some upside on prices as November and December comes. That's one. The second point I would make is that China has been the wild card, and everybody has been saying, like China is the vacuum cleaner of the oil markets, which is helping. Despite OPEC announcing a lot of the supply, China takes it, stores the barrels, and that has been keeping the oil prices. My view is that maybe the storage in China may slow down, but it's very hard to call. So the uncertainty around China's buying will continue to, and this will not let the oil prices stay much lower, below the 60s sort of a mark. So I know there are EIAs and other agencies are talking about oil prices going to 55s and 50s. I'm not in that camp. When we talk about the higher side of the oil price, I'm also not in the camp that there's a lot of sentiment being talked around. The OPEC plus spare capacity is less than what it is, so we should be prepared for a very bull run. I would say that the real spare capacity is probably with China, with all the oil stored. And if the oil prices probably go somewhere above 70s to 75, China is not going to sit idle and bring these barrels back into the market and sell the barrels and make its money. So I would say that China's ability to store will provide the floor. China's ability to bring the barrels to the market will also provide a cap on the oil prices. And the OPEC plus is probably a more nuanced, which I can touch upon a little later.
Mukesh, coming in also on India and Russia, I mean, yes, between US and China, that headline seems to be kind of getting faded there, but I'm sure it'll come back to fore very, very soon. How are you looking at on what India continues to buy from Russia? And that's not going away too easy, is it?
I think you said it very well. It's not going away too easy. It's one sometimes there is too much focus on the discount side, and that's why India is buying. I think India is buying also because the quality of the Russian barrels is what the Indian refining system can easily handle with. If Russia was producing the WTI light barrels, probably India might think twice unless they get a very good discount. So it's the chemistry of the oil which is very important when we look into the headlines. So going forward, I think India would continue to buy. And if you look at some of the data points, yes, the numbers have not slowed down. But what is more important to watch is that indeed Ukraine is striking hard in Russia. It's striking the refineries. And in the past, if you strike a refinery, there is some spare crude oil which Russia can export, but they are also striking the export terminals. So there might be certain challenges in the logistic side of the barrels, even if Russia can produce. But if we take a picture for next 6 months, I would say Russian economy on the oil side is not doing great. The oil companies lost probably, for some estimates, about 22% revenues were down year on year. So the Russian productivity, the technology side, the capex, the revenue, and then the logistics will pinch hard. And Russia used to produce somewhere around 10.3 million barrels per day, but now it may not come back and might stay around 9.4, 9.5 million barrels per day. So that if that happens, India will continue to buy the barrels. And if there is a decrease, then maybe others may not get those barrels. But I think it will continue to flow to India because it's the right quality.
Mr. Sahdev, you made a point about OPEC earlier, and well, yes, the November increase in output does seem lower than what they've done in September, October, but with the kind of oil that they already are bringing back with all these monthly increases, what is the OPEC's next strategy as per you?
Great question. I would just say whether we are talking about OPEC or we are talking about an OPEC market, right? They sound very similar, and that's what it is. There is a lot of headlines that OPEC is bringing the barrels. But if we look deeper into the numbers, these barrels may not make it to the export and supply market. a lot of these barrels are actually going to their refining systems and which are making products. And those products are getting into the European markets. We have seen how diesel was a big craze in European system. So Middle East is not just playing, and the OPEC members are not just playing a crude side of the equation. They're equally very active on the product side. So I would say that just looking at the crude headline numbers doesn't tell the story. We also need to look at the product side. So all the targets are being raised. All the production may not come back. And even if whatever production comes back, it may not make it to the market. It will go to their refining systems and more products come to the market. That's how I would say that OPEC is calibrating the market at this moment. And playing the crude handle, playing the product handle is a fantastic way of keeping the oil prices stable. Manisha, you can imagine with such geopolitics, the oil price should be dancing a lot more around, but it doesn't do that. And the exact reason, in my view, is that OPEC knows how to handle the crude side. OPEC knows how to handle the product side. And that is a big enabler in keeping the market stable, but volatile in a narrow range.
Mr. Sahdev, I'm still smiling on your OPEC and OPEC version of it, which does truly fit with that. But talk to us also about the India oil strategy going forward from here. Well, yes, India has increased its mix from various countries that it imports from right now, but it still is suffering with that 50% tariffs nonetheless. How are you looking at, one, India's imports, the kind of refining that India does, storage plans that India has?
Excellent question. I was in Kuala Lumpur, meeting a lot of key players there. I was recently in Delhi and Mumbai. I think India's position has been well articulated that India is buying from a diverse markets. I know before the Russia thing happened, India was probably buying from 25 to 27 countries, and now probably India is buying, as numbers are being talked around, from 40 countries. So it's not just that while India is buying a lot more from Russia, India's diversity is reduced. So India's diversity of buying is actually higher, and I think that will continue. The second point, I would say, from a bit of a medium-term point, there is a lot of talk around India leveraging its scale, leveraging its position in the market, and explore better trading plays. Because, Manisha, you can see that those who have the assets today and have the scale are really leveraging the trading markets, really leveraging the volatility in the markets and making some extra dollars just depending on an asset is a tricky thing in a very geopolitical world. You need to do right risk management and hedging. And what I've learned is that India, a big number of the Indian companies are exploring the trading play. So that, I believe, would be a key enabler for India to get growth. If I take a little bit longer term, and I'll keep my answer short here as well, that India is aspiring to take capacity of refining to 9 million barrels per day. I think that's a good move. If we are also sort of capturing the petrochemical sector along with the refining sector engagement. So India has the scale. India has a big domestic market. That's why these kind of ambitions serve well. I live in Australia. Australia is one of the biggest short these days in the refined product markets with more than 1 million barrels product imports. Okay. Now, someone can ask, you should build refineries, but they don't have the scale, and India has the scale.
All right, that's a good one. That's a plus clearly that India has. Mr. Sahdev, thank you so much for joining in and putting light on what really is happening in that oil and gas situation in the global markets as well as India as well. Great speaking to you, and I'm hoping that we'll get you soon again. But with that, that's all the time that we have on this edition of Big C. Thank you for watching.